Rolls-Royce rose 5.15% on 12 June, reaching 1,224 pence and delivering the FTSE 100 its best session in a month. The catalyst was a trading update that reaffirmed full-year guidance, operating profit of £4.0 billion to £4.2 billion, free cash flow of £3.6 billion to £3.8 billion. On the surface, that is a guidance hold, no upgrade, no downgrade. But Jefferies analyst Chloe Lemary flagged something specific in the language. Rolls-Royce used the phrase further confidence in describing its outlook. Lemary noted that this is the same wording the company has used in prior trading updates, immediately before upgrading forecasts at interim results. The distinction matters because a guidance hold and a pre-upgrade signal are priced differently. A hold supports the current multiple. A pre-upgrade signal suggests the multiple should expand before the upgrade is confirmed. The market's 5.15% move suggests partial pricing of the upgrade signal, but analysts' mean target of 1,400 pence sits 8% above current levels, implying the consensus has not fully committed to either read. The hidden assumption embedded in the bull case is that management would only use that language if they had already seen the trajectory that makes an upgrade safe to signal. The hidden assumption embedded in the hold case is that further confidence is standard reassurance language, not a coded forward commitment. Both assumptions are simultaneously active. Neither has been confirmed. The interim results expected in the second half of 2026 are the checkpoint where one of these assumptions gets falsified. While the 5.15% rally absorbed the guidance optimism, it priced through an active overhang that has not been resolved. Emirates, one of the world's largest operators of long-haul wide-body aircraft, has raised concerns about the durability of specific Rolls-Royce engines in harsh operating environments. The concern is concrete enough to have delayed aircraft orders while the manufacturer continues implementing technical improvements. Rolls-Royce's response is investment in engineering upgrades and maintenance capacity, but there is no published timeline for when Emirates would consider the durability threshold satisfied. This matters for the standing read in two ways. First, Rolls-Royce's civil aerospace revenue depends on long-term service agreements, contracts that charge based on engine flying hours. An engine that airlines are cautious about ordering directly limits the flying hour base those service contracts draw from. Second, the company reaffirmed £4.0 to £4.2 billion to Guinea on a book of business that already exists. The question the durability overhang raises is not whether that guidance is achievable, it likely is, but whether the multiple expansion required to close the gap to the 1,401 pence analyst mean target is supportable if the next fleet cycle order flow is constrained. A standing read that treats Rolls-Royce as a transformation-complete, order book growing aerospace name assumes the Emirates concern is a minor operational footnote. A standing read that treats it as a structural ceiling on civil aerospace re-rate leads to a materially different valuation. At 1,224 pence, the market has not explicitly resolved this question. It has chosen partial optimism. The monitoring variable is Emirates' order pattern. A resumed wide-body order from Emirates using Rolls-Royce power plants would confirm the durability issue is behind them. Continued absence of switch-in order would sustain the overhang into the second half. Rolls-Royce's transformation story has been priced as a civil aerospace recovery with a defense tailwind. That framing is now incomplete. Demand for backup power generation from AI data centers has accelerated significantly, and it is Rolls-Royce's Power Systems division, not its civil aerospace unit, that addresses this market. The company has confirmed that AI data center power demand is a growth vector within Power Systems, adding a third earnings stream alongside recovering long-haul aviation and expanding European and North American defense budgets. The analytical implication is not straightforward. A company that derives material earnings from three structurally different demand sources, long-haul aviation recovery, government defense spending cycles, and digital infrastructure build-out, is not well priced by a single-sector aerospace valuation multiple. The analyst mean target of 1,401 pence was constructed primarily against the aerospace and defense framing. If Power Systems' data center contribution grows to a scale that requires a separate sum of parts treatment, the mean target is likely underestimating the fair value range, not because the company has changed, but because the framework being used to value it was built for a different business mix. This does not constitute an automatic upgrade path. It is contingent on Power Systems delivering Power Systems numbers. But the interpretive gap between the standing aerospace framework and the emerging multi-division reality is where the second "I didn't know that" moment for this stock lives. The $7 billion to $9 billion multi-year share buyback program, currently in its first $2.5 billion tranche, is the management team's own capital allocation signal. They believe the current price understates fair value. That signal and the analyst mean target sitting 8% above current levels are aligned. Whether the Emirates' durability concern delays the market's willingness to close that gap is the residual variable heading into interim results. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.